Hi, I'm Steve Forbes, and you're watching Traders Nation.
Welcome back. You are tuning in to Traders Nation. My pleasure to have back with us once again Jeff Small. He's president of Arbor Financial and author of Turning Financial Planning Right Side Up. Jeff, welcome back to Traders Nation. How are you today?
Hey, I'm doing great, Kurt. It's great to be back.
Hey, glad to have you here. All right, so yesterday's session went down in history as the longest bull run. What's your take on that?
Well, I think we're in the longest bull market since, I guess, the 90s to 2000, and so we eclipsed that great expansion of market growth and the technology boom. And I see a lot of similarities, Kurt, to where we were in 2000 compared to where we are today.
Yeah. It's interesting. I don't know if you got caught up in this or if you heard about all this, but there was this huge discussion, or an argument, if you will, on the last edition of Traders Nation. The big argument out there is, well, what constituted the longest bull run? When did it really start? And I guess there's a lot of talk about that going on out there, Jeff.
Well, I think there is, but I mean, the bull run started in March of 2009, Kurt. We had that huge collapse in 08 and 09, and it took 12 months to recover. Hit a bottom, 676 on the S&P. Yeah. I mean, that's obviously a down from 1549 of October of 07. So you tell me when it started.
That's right. Well, yeah, I know, and I'm not going to. That's for sure, because a lot of folks they have the differing opinion when that actually occurred, and I think you're right on the nose with that. So let's talk about some numbers here, because the S&P 500 rallied about 323% since then. NASDAQ, biggest winner of all of them, 611% gains since then. And the Dow, 300%. I mean, Jeff, where do we go from here? Those are big numbers.
Well, there's no doubt, and that's why I say we're approaching 2000 levels. The trajectory of the market just can't keep going straight up and straight up.
Yeah.
But what's happening now is that we're on a rising rate cycle. That's going to freak the markets out. The Fed's raising rates because they know what's going to happen. We're coming to the end of the party. Whether that's going to be 12 months, 18 months, or 24 months, who knows? Yeah. But they're raising rates because the last 18 times they went through a rate hike cycle, Kurt, what happened? We went through a recession and a stock market correction.
Right. All right. So big concern, I think, a lot of folks is that there's got to be enough momentum in this market, in the growth of the consumer market, and the concern here is that the Feds, and the Feds are certainly looking at this too. What kind of rate hikes are they going to be doing, and how bad or will it all affect the markets? Especially if we get a ton of steam behind our economy, will it affect it at all, Jeff?
Well, equities can go up in a rising interest rate environment. It's just that, when the economy starts to slow down and goes into a downturn, or we see too much debt out there. We have this debt explosion, and nobody's talking about that. It's just not domestically, but it's globally, and it's not just private; it's public as well, and it's just exploding. And so, at some point, I think we see an actual debt crisis globally, and that happens when, of course, we can't service it any longer, and we start to see implosions in different components of the credit markets. Yeah,
with no doubt about that, because discretionary consumers price indexes, that's up 635%. It's huge. And we're seeing it right now in the payment processes, which we talk about a lot on Traders Nation. MasterCard, Visa, PayPal, Square, all of them doing very well, phenomenal in regards to the market. So we are seeing a huge increase in consumer spending. What are we going to do about that debt? Because at some point, we can't afford that anymore. Folks just out-debt themselves. They're feeling too good, Jeff.
Well, there's no doubt. And, credit cards have peaked. Corporate leverage has peaked. College loans have peaked. Auto loans have peaked. Mortgages have peaked. And so we're at this point now where if we keep expanding the debt, we're going to enter in a zone where it can't be serviced because too much debt's been issued. And that kind of happened to us in 2008, 2009. But that's kind of what corporate America's done. They've borrowed as much as they can to do what? Buy back their own stock. And that's why the market still has its head above water right now, because of all the demands for stock. 60% of all stock trades are corporate stock buybacks. It's not me and you buying it, Kurt.
Right. Oh, listen, all those peaks that you just talked about, you just rifled out, certainly it almost sounds to me like there's no room for error. It sounds like those are all subject to potential bubbles at this point when it comes to the debt.
Well, that's right. If we study the debt cycles, we know that they go through a saturation point, and then that point hits a point where people can't service that debt, and we start to have defaults.
Sure.
We're already starting to see high defaults in a couple of different categories, and actually in some parts of the country, I hate to say it,
Yeah.
Home foreclosures are starting to uptick, which is a little scary. And so hopefully that's just an aberration, and that's not going to happen. But we are in an expanding economy.
Not again. Not again. I mean, folks, if we haven't learned anything, we got big troubles, because if we're starting to see foreclosures, I'm seeing a lot of building going on. As I drive around, because I'm in Phoenix, fifth largest city in the United States, I think. But nonetheless, I see a lot of building going back on, which I'm excited to see that. But boy, I tell you, if we're seeing that building and we're seeing the foreclosures starting to rise again, hopefully you're right. Hopefully maybe it's an anomaly. Okay, maybe we're just seeing that. But I think we got big problems if we start seeing that again, Jeff.
Well, there's no doubt we do. And, today new home sales were down a tick, less than expected. Manufacturing dropped off a little bit. So we're starting to see some parts of the economy that are saying, look, it may not be quite as strong as we had hoped, even though we're in a very strong consumer-oriented optimistic phase. Yeah. When optimism peaks, it generally follows, things that don't work out very well economically.
Right. All right, so not everybody was a winner in the last bull market run, or the one that we're currently in right now. Certainly Mosaic was a company at the bottom. Apache Corp, another one, APA, were at bottom performers during this period. So not everybody was a winner during this period, right?
No, not everybody was a winner, Kurt. And, we've got hundreds of millions of dollars under management, and I'll tell you that when I evaluate somebody's portfolio, they have not done very well the last 8 or 9 years. Nobody's even doubled their money, even though the markets are up over 320%,
sure,
and the NASDAQ's up over 600%. It hasn't happened.
Were they just not poised correctly in the market, or are they just in the wrong sector or the wrong space? What was it that dragged some of these companies down like this? It just didn't participate in the market as others ones did well.
Well, I think, we have the greatest issue right now is that the difference between 2000 and today is in 2000 it was the tech stocks that really carried us. Now we have this pervasive issue in the market where everything is overpriced, and the price to sales ratio was double what it was in 2000. So technically the market's overvalued by a factor of 100% compared to 2000. So I think some companies have done well. It's just that we haven't had the growth that we had in the 90s that we've had the last 8 or 9, 10 years here.
I see. All right. So after the Great Recession, some people had a hard time getting back in the market. And again, I don't blame them, because some people really took a haircut. Now they're feeling a little left behind. Should they play to get caught up, or what should they do?
What should they do? That's always what wants to know. What should they do?
Because they're sitting here, Jeff, they're sitting here going, you know what, I was really, gun shy getting back in, but now everything looks great, and I'm hearing all these big numbers, and it's like, I feel left out. What should they do?
I hate to plug it, Kurt, because, but they got to buy my book if they want to know what to do. Right. My book has the Goldilocks zone chapter in it that tells investors where they should be the next 10 to 15 years and why. Yeah. And so they need to buy the book. But the bottom line is we're in the 90th percentile of valuations. There's very little upside, substantially more downside in the market. If you're going to squeeze out the next 5 or 10% of growth in the market, God bless you. Is it necessary? No, it doesn't do you any good if you go through the down. Right. The problem is we don't know when to get out when we start to go down. Right. That's the problem. February this year, great example, 9% drop. We're all looking around at each other saying, here comes the correction.
Right.
Here comes another 10% drop in March. Right. Didn't happen. Right. It flatlined until May and then went bullish. So nobody knows what's going to happen.
Well, and those are all the pros. They're looking at that. Imagine the guy in the street has no idea whatsoever when that next one may come. And I think that's the biggest problem we're running into. By the way, Jeff's book is Turning Financial Planning Right Side Up, and we'll get to that in a second. All right. In fact, we're there already, Jeff. And it literally was a second, wasn't it? All right, so Jeff, that's right. Where can we get a copy of Turning Financial Planning Right Side Up?
Well, of course, they can go directly to Amazon. The book has a website, financialplanningrightsideup.com. There's links to Amazon there. They can read about the book and see a few pages if they want to buy it or not. So that's the best thing they should do.
Awesome. Jeff Small, president of Arbor Financial, author of Turning Financial Planning Right Side Up. Thanks, Jeff.
All right, thank you.